Okay, so I really have two agenda items. They both relate to macroeconomics, but they're almost opposite in um, tone. The first is I want to talk about, theory at a very abstract level, and then I want to talk about sort of where the economy is today and sort of the confusing mix of indicators that we have. So the theory point I want to make is that macroeconomics, as it's come down to us, is very top down. And the alternative that I call PSST, Patterns of Sustainable Specialization in Trade, is very bottom up. So, how do we determine nominal GDP? So in the top-down model, it's like the government has a dial and it turns the dial. The best example of that would be Scott Sumner's view of how nominal GDP gets determined. It's just the Fed can do it. The Fed just watches the forecast, and it's like you're turning the dial on an oven to get to the right temperature, and it does it. And so, you know, if after the fact the Fed hasn't hit what seems to be a reasonable target, and a reasonable target is just kind of keeping nominal GDP on a trend line, then the Fed just messed up. I mean, that there are two possibilities. Nominal GDP goes on it's a nice trend line, or the Fed messed up. That's kind of the and again, to me, that's very top down because economic activity comes from households and businesses making decisions and doing things individually. And then the notion that you can just turn this oven temperature and create uh, uh, and set the level of total economic activity. Um, Again, it feels very intuitive to Scott Sumner. It feels very intuitive to anyone who took a macroeconomics course, but I think it's wrong. Let me give one example. Um, does anyone know what the acronym JOLTS stands for in economic statistics? The It's Job Openings and Labor Turnover Survey, and and among the macroeconomic statistics, it's a relatively new one. I don't know when it started, but to me, it's new. It's probably 25 years old, but to me, it's new. And what it does is uh, they ask businesses how many jobs have been destroyed and how many jobs have been created. But it's in gross terms, and it comes out to typically about 4.5 million a month. But if you look at the headline employment numbers called the payroll survey, they're typically like this last month, there were 265,000 jobs created. So 4.5 million new positions, four, and presumably about 4.25 million layoffs or separations. It could be, voluntary separations, involuntary separations. So there's this gigantic churn going on. And what this dial is supposed to do is fine tune the net of that because only the net change, the 265,000, is likely to be correlated with GDP, with nominal GDP. Um, so there's this tremendous amount of economic activity floating up from the bottom, and a tremendous variation in it. These, 4.5 million jobs being created and 4.3 million separations. Um, there's all this ferment going on, and yet what we pay attention to is just the net, the difference between the gross and net. So the question you can ask about the PSST story is, well, what is the story for what accounts for the net, for the small, for what causes nominal GDP to change, and why can't the Fed just turn a dial and make it happen? What would happen if the Fed, so I guess I'll use a different metaphor. I think that the Fed has something like the steering wheel in a bumper car race, or a bumper car thing, where if you've ever ridden bumper cars, you know that you really, you may be determined never to have someone crash into you from the side or the back, but you don't have enough control over the bumper car to make that happen. And that's my picture of the Fed trying to um, hit a nominal GDP target. It's like trying to ride a bumper car and never get smashed from the side or the back. The So what I think happens every month is that businesses, large and small, add workers and subtract workers. They tried new projects. It might be a new project within a large corporation, or it might be a new enterprise. Some of these new projects work out, some of them fail, um, and um, that kind of produces what we might call real GDP, real output. Um, and then they also make price decisions, and their price decisions are influenced a lot by what people have come to expect and what people have experienced. So, if in a non inflationary period, uh, somebody in a reasonably competitive market, like, I mean, you go to a grocery store, there are a bunch of different cereals or different yogurts. If uh, Cheerios, if General Mills decided to raise the price of Cheerios by 20% in a non-inflationary market, people would kind of notice that and go, "Oh, what's going on with that? That makes no sense. I'm not going to buy that now." So they're somewhat restrained, but once inflation gets going, then they get more of a license to raise prices. So why does employment fluctuate? And my answer there is there are many different reasons. It's sort of like the all unhappy families are different kind of story. Sometimes we've had situations where the price of oil shot up and sort of firms that were dependent on oil had to cut back. We had the tech boom and crash, 1999, 2000. We may be experiencing a similar thing now. Um, and one theory that I've been playing with, I didn't have this in my book, is that firms in really good times tend to hoard labor. I think there was always evidence of this. There was called, when I was growing up, there was a paper on that was entitled "The End of Expansion Productivity Effect." That is, near the end of an expansion, productivity would decline as firms were adding workers who weren't all that productive or hoarding workers that weren't all that productive. Why you might do that is uh, you've noticed that it's a tight labor market. It's hard to hire people, so you err on the side of keeping people rather than letting them go. Um, I think one implication of that is that if the hoarding just goes on and on, it creates what uh, I'll use a metaphor that Paul Krugman has applied in other contexts, a Wile E. Coyote situation, where Wile E. Coyote runs off a cliff and doesn't realize he's off a cliff, and then all of a sudden he falls down. And I think um, sort of once enough firms start realizing that they've got more labor than they can use, then and a few of them start doing layoffs. Others may say, "Oh, well, the labor market's not so tight now. If I lay people off, it won't be the end of the world. I won't lose all my good people. So maybe I'll it's okay for me to lay workers off now." So there otherwise, the reason I bring that up is I have a hard time explaining 2008, 2009. Uh, the magnitude of the drop in employment was just enormous in 2008, 2009, way beyond anything that you could explain by looking at housing construction. I mean, the housing construction is just too small a share of the economy. So it's almost like, a signal went off to all sorts of businesses um, to lay off workers. And I think one of the motivations in today's economy for laying off workers is that um, you're trying to you're trying to get your financial situation in order when capital becomes scarce. So capital became scarce in 2008 because banks were they were trying to solidify themselves, and then and so that creates a need to lay off workers, just as all of a sudden, Meta, Facebook has discovered that it has a need to lay off workers because the capital markets are not as forgiving as they were a year ago. And I think that's kind of uh, a story of sort of, explaining sort of why modern layoffs tend to clump together. And so if that'll get to when we talk about the current economy, you'll hear me say that I think that we can see clumps of layoffs sometime down the road. Don't know when we'll see enough to sort of show up in the data, but that seems to be a prospect. Um, let's see. I had one other thing maybe to say about this labor hoarding, but all right. Okay, I'll take a Tom Gray question first or comment.
Uh, the common part is in the 2006 end of the housing construction boom, there was a huge layoff of illegal aliens who were working in construction. That huge amount of layoffs was not reflected in this 4.5 million number, which is the official number. And I think one of the um, problems we have is dependence on the official data when there's real data that's not being collected. And my claim was that despite the layoffs of the illegal aliens in construction, there was still increase in other areas. So it hid it for a while until the mortgage-backed security problems in finance combined with the reduced real GDP, which the illegal alien GDP is not fully included because they get money. They send some to Mexico. They pay some in cash in the cash economy. And so I think that you mentioned the data. I think there's a million, uh, up to a million, maybe 2 million of unregistered changes that happen in these problematic times.
Okay. Um, okay, so then uh, I can come back to that in a minute. Um, so the so my story of business cycles is you get booms when sort of everyone can get capital. So the guy who wants to start the new firm can get capital, and the guy who's in the zombie industry can get capital. The classic case being sort of, you know, when did people decide that newspapers had to fold? It seems to me it took a very long time relative to when it seemed obvious to a lot of people that newspapers were kind of a dead business. Obviously a few newspapers have hung on, but only very few. And um, so so a boom is when the disruptive companies are expanding, and the older companies don't want to admit that they're zombies. And a crash comes when capital becomes scarce for both, uh, because investors suddenly realize that that their optimistic models aren't working anymore. So that brings me to kind of the current situation, which is really, there are so many indicators going back and forth. I mean, even about the housing market, Kevin Erdman will cite, that the the problems on the construction are kind of on the supply side, that they can't get, still can't finish the houses they've started. Um, I think it's more and more looks to me like there are going to be problems on the demand side. Um, but it's going to be interesting because people have to live somewhere. The most interesting statistic, and I'm not sure I believe it, it came out in, I think it was in like the tablet or this or somewhere in their news thing. They said that a year ago, 11% of people, of adults, were not paying rent. That is, they were living with parents or with other people who were paying rent for them. And now that's 18%. So it went from 11 to 18 in 1 year, which seems really implausible, but but it's interesting. And what might make it plausible is it's just that housing is really becoming scarce, that it's really, um, we've underbuilt housing. Is I think I agree with Kevin Erdman on this one, that we've underbuilt housing for, a dozen years, and housing has become scarce. Now, why would it have become suddenly scarce in the last year? Um, I guess the possibility is that, these people's stimulus checks ran out and they're now freeloading in a massive way. I don't know. I don't know. I would give that statistic a non-zero probability of being a complete lie, but it was interesting. The um, the going from the least reliable statistics to the most reliable, I still consider the payroll employment data the most reliable. And I was surprised, as I think Wall Street was a little bit, that the payroll employment gain was as much as it was last month. I don't know I think they might have revised down the previous month's gain. I'm not sure if anyone follows that. So that may have offset the gain somewhat. Um, but it'll be interesting to see in the next couple of months whether that falls off. I mean, 265,000 is kind of below the threshold at which, it never drops suddenly. I think we're at a point where, um, the momentum isn't tremendously high on the high side. So I still have, quote, hopes that we'll see the employment data fall off a cliff sometime, uh, let's say before January or February. Um, Inflation data, a lot of conflicting stuff. Unit labor costs, I think, didn't grow at too high a rate in the last quarter. They grew at a very high rate the first quarter. Um, so that's, but that would seem, your labor costs is probably if you believe in the GDP factory, your best indicator of where kind of underlying inflation is. But there's, again, a lot of different straws in the wind on that. And, um, I guess, there's a lot of view in the economics profession that there is a lot of momentum generally in inflation, so that inflation expectations get built in, and in fact, some people are waiting for labor market inflation. They think that workers have put up with falling real wages for longer than they're likely to. But anyway, So that's an interesting one. Let me turn, since someone's raised his hand. Dwayne, go ahead. You have a comment or question? You have to unmute
Oh, no,
yourself.
just back to your question on what might have driven the 11 to 18%. We've had in the multifamily sector roughly a 20% increase in rents in the 12 months, let's just say ending July. And I know many people who, after several years of 10% increases, right? So the apartments, the multifamily sector's had a good 10-year run. And since after the great financial crisis. And lots of capital gravitated towards that sector. And so there have been people that have literally been priced out of the apartments, right? So, you can't have wage growth in the 5% ballpark and have rents go up, a couple of years in a row, close to 20%. People will, move back in with their parents. They'll double up in spaces. And so, just what may have triggered, you were looking for the explanation. What may have triggered it was just that big escalation in rents. Now, there have been many people reporting that in September and likely in October, the multifamily sector has chosen to not raise rents at all. Right. So perhaps, they're seeing lower occupancies and they're responding first, right? There's lots of lags in the system, but I just thought I'd share that. There have been massive increases on par with the increases that occurred for the used car market, for example. And we know how that's starting to reverse as well.
Yeah. All right. Anyone else have any thoughts on what's happening now? Okay, go ahead, Lee.
So I was having lunch with someone today, and can you guys hear me, by the way?
Yeah.
Okay. I was having lunch with someone today, and what I realized was the Fed has three purposes or three things it needs to do. One is to understand the current situation. One is to project the future. And then the third is making a policy decision based on some combination of the present and future. And I realized as I was sitting at lunch that I think they're making a few mistakes along the way. Number one, I think they're not really projecting the future very well. I think they're either taking the past and then just continuing it in a straight line and saying, well, it was 8%, for 3 months in a row, so it'll just be 8% forever. I don't think that is a very effective way to project the future. And projecting the future is hard. There's a wide margin of error and very few people are good at it, but it's of vital importance, and I don't think they're doing that well. I also think that it seems to me that the Fed is very focused on trailing data rather than any sort of a projection of the future. And so I think the Fed is saying, well, it was 8% for 3 months, so that's what we're going to base our decisions on. Again, not looking at the future. And then the third piece is, what is the right policy prescription based on that? And here again, I think the Fed is maybe failing, though less so, because if you give the benefit of the doubt and you say they're making decisions based on the past data and they're just extrapolating that out indefinitely, if that were in fact true, they're probably making the right decisions. I just don't think that's the right way to project the future and the right thing that you can extrapolate. That's not a trend line that you can bank on. So that's really, to me, where the Fed is going wrong, and the problem with the current picture. I think they have they waited way too long because they didn't understand where the data was and didn't project it well. I think they have now grossly overreacted and have raised rates much too high and too frequently. And I think we're headed into a real recession. The job losses are starting, and they're only going to get worse. Doesn't mean it'll never reverse, but like I think they've overreacted in a pretty big way.
All right, Mike, you have a hand up.
Yeah, this is kind of skipping before Lee, so apologies. Just thinking about the multifamily stuff. I look at this market as an investor. You know, I see deals and participated in a few over the last couple of years. And what struck me at the end of last year, where I kind of paused here, was they're all looking at 3 to 5 year exits, and they're all using floating rate lending, right? And it's I don't know, Dwayne, if you've got a deeper insight into this market, like how pervasive is that? Because the bill's going to come due on a lot of that lending, and who's gonna be on the other side of that 3 to 5 year flip. So that could be really interesting.
Wow. So yeah. I had a professor who spent some time 1 year as a staff member in the Council of Economic Advisors, and he said the hardest thing to forecast is the current quarter. So relating the present, sort of the present and the future. I mean, he didn't say. He wasn't implying that the future was easier. He was just sort of saying that it's really hard to even get the current quarter correct. And I think that seems to me it could be especially true now. There's so many random things going on. I mean, I don't know how much decoupling with China is going on. I mean, if there's a lot, that's a really adverse development. If it's just all smoke and mirrors, and actually underneath it all, trade is going on, and we're still buying as much stuff from China, and China is still producing as much stuff, then it's a very different story. I imagine whether Russia lets grain out of Ukraine or not is going to make a big difference to things like inflation and sort of conditions in other countries. I still don't have a clear idea of Europe's prospects. Are they going to get through the winter, or are they not? Are they going to end up shutting down? Is Germany going to end up shutting down its factories so that its people have enough heat to survive the winter? Okay, go ahead, Tom. You have...
Yeah, I live in Europe. They're not going to shut down the factories. They're going to burn coal. And the Greens were successful at closing the nuclear power, and successful at stopping fracking, and successful at reducing LNG, but they're not going to stop the factories. They're going to burn coal.
Yeah. Okay. Yeah, Dwayne, go ahead.
Yeah, the question you're raising is the immediacy of data, right? So we need good information. We're trying to see, we raise rates 75 basis points last week. How long does that take to have an impact in the real economy? My business is, Mike, to answer your question, is not the multifamily sector, it's the retail sector. We have a large portfolio with institutional investors of shopping centers throughout the state of Florida. But what's interesting is I'm an operations research engineer by training, and so I go out and I don't trust any of the data you can buy online. So I physically go out in the field and regularly do those hard surveys. So last month, we went to every shopping center in Tampa, serves 3 million people, to determine what their year-over-year change was. Great. Largest ever increase in occupancy over the last 12 months that I've ever seen in my life. I've been doing this for 40 years, 200 basis points. They're down to 6% empty space. I can tell you that every landlord that I know is going to raise the living daylights out of their rent when it comes due. So I know Jerome Powell's trying as hard as he can, but if and all my brothers in landlord land don't have any delinquent tenants from the stores, right? Two-thirds of our economy's the consumer. So if the grocery store is paying his rent and the sandwich shop is paying his rent, we're certainly not going to see increased vacancies. And until these folks are under strain, it's very unlikely they're going to refrain from increasing their prices when they're landlords. We don't have a big incentive right now with highest occupancies we've ever had in history to consider lowering their rents. Especially in light that we all are experiencing our floating rate debt is going up, and we're going to have to pay that bill. So we're going to respond by lowering rent. So I would love to hear more data points, Arnold, because we can't just rely on the jobs number alone, right? I mean,
Right.
I'm looking everywhere I can to find where are those data points that can tell us when this might end and when do we revert, as the 10-year tips are telling us, or the 5-year tips. When do we revert to this 2.5% inflation average? Because
Yeah, I don't know. The one thing, that was recommended to me was the data tracker from I think it's the Bank for International Settlements. I forget. I cited them at some point in my Substack, and they so what they do is they look at all sorts of current data, using like search data from Google and things like that to try to assess things. And so it's and the last time I looked, they've said, things are okay. Looks like 2% real growth. Looks all right. Tampa may be doing well at the expense of some of the blue states that are losing. I mean, I assume that retail and population are pretty closely related. So if you're gaining population, you're probably doing better than if you're losing it. Lee, did you have another comment you want to make?
Yeah, so to what Tom said about the factories in Europe, I had meant to tell you, and I think many in this forum will enjoy, that there was a publication I discovered fairly recently called the German Marshall Fund. And I don't know if you read that one, Arnold, or if any of the others here read it. But it's like a not-for-profit sort of think tank focused on transatlantic relations, and they have sort of an in-house scholar or fellow who writes some great pieces on transatlantic relations. And he had a piece last week that was really looking at how much Germany has become a sort of vassal state of China, and how Germany has become so dependent on China that it's not really functioning as a valued member of the transatlantic alliance anymore, because it is completely sold out. And so
is that because of a lot of cross-border trade going back and forth? So Germany,
it's one directional, right? Okay. It's Germany is buying energy from Russia, so they're completely dependent on Russia, and then using that energy to run the factories, which are producing goods in various states, from raw materials to finished manufactured goods that are being exported to China. A lot of it is raw materials, right? BASF is producing, it's not just the most raw chemicals,
right?
Usually one stage and further along in the value chain, but those are vital inputs to a lot of stuff that is manufactured in China. And so when you're completely dependent on Russia for your energy inputs and for China for all of your outputs, you are sort of at the behest of both, and not able to push back on either.
Okay. So anyway, so I think if I had to make, okay, the other sort of unknown is sort of where the stock market is going to settle. It seems like, I remember saying that, well, 4,000 for the S&P is too high. That if we, if it stays that high, there will be enough wealth in the economy to keep inflation going. And 3,500 is probably too low. And I think the market's sort of acting as if that's true right now. That it has a hard time getting below 3,500, and probably is going to have a hard time getting above 4,000. So if I were really active and skilled in playing the options market, I could make that my the basis of options trading. Every time the market gets close to 4,000, I could buy puts, and every time it gets close to 3,500, I could buy calls. And if I'm right, I would be very rich. I'm not following that strategy, so you should know I haven't put my money where my mouth is there. But I think there is something, my my model of inflation is not very quantitative. I continue to think there are two regimes. There's a regime where inflation is low and stable, and there's a regime where it's high and variable. And it's very hard to kick the economy from one regime to the other. When it's low and stable, that's kind of self-reinforcing. Everybody walks around expecting the prices of most things today to be about what they were yesterday, and you can't make a big price increase stick. If you, but if you're in the high and variable inflation thing, then regime, then kind of anything goes for price increases. I mean, my wife has seen her yogurt price, shoot up, and we don't know whether whether that's justified on a cost basis or not, but it's easier to stick in an inflation environment. All sorts of prices can go up. And that can be very hard to stop. The rent increases are going to be very hard to stop because it's going to be hard to bring new supply into the market with interest rates being where they are. Still, I think there's enough. I guess I think there's been enough wealth kind of squeezed out and used up that I think it will become a little bit harder over time to get price increases to stick. And certainly if we go into recession, it will. But then the other way of looking at it, the Jason Furmans and others look at the labor market and say, we're just going to be hit by wage increases, and that's just going to build in a lot of inflation going forward. So but again, I'll stick with my prediction that before that happens, we'll see enough layoffs that workers won't be so frisky, but we'll see. All right. Yeah, Tom, go ahead. You have to unmute.
I was going to agree with you that it's not going to take very many layoffs for the labor market to avoid wage inflation, because one of the trends that we haven't talked about yet with respect to the data points is the increasing stability and the lack of mobility of workers, and especially in the two-wage family. If your choice is to stay at a job that you think you're underpaid on, and you should get a 20% wage, but you have to go to a new city, and your wife or your husband is happy in their job, you don't take the 20%. When I was single in Silicon Valley, you get a 20% offer and you bounce, and you bounce, and that's nice. But I think that there's a lot of labor stability, and on the job turnover, one of the things that's not talked about is how many people got new jobs in the last year and got new jobs in the last 5 years. So if it's 4 million a month in a year, it's that's what, 50 million. How many of those are new people? I have the feeling that a lot of that churn is the same people going from McDonald's to Burger King or something else and coming back. So, and I don't think it's the college educated or even the skilled plumbers who are doing that so much.
Yeah, well, presumably if you've got built up a lot of human capital in one industry, you're not going to be able to change industries that easily. You might be able to change firms, but yeah. Okay, well, I have no feel no obligation to keep this going for longer than we have. I think.
But I had a question
Okay,
for
well,
the others.
that's
Sorry, what to invest in now? I think that's the key decision for everyone to make, and why? Because I don't know.
wow.
Arnold, do you expect the elections will have outcome will have any impact on your forecast? And are you expecting any surprises, or how do the elections weigh in on your forecast, or do they have any impact whatsoever?
Well, if the Republicans were old-fashioned and tight-fisted, I would say, well, we'll see less, some lower path for government spending and so on. I'm not sure we'll see that because I don't think they're as old-fashioned. Um, I'm, okay, so Congress just does not control the regulators. I mean, that's the one thing that's really in Biden's hands. And that's probably the thing that they could most do to affect the economy. I mean, going back to Jimmy Carter, he had this fellow Alfred Kahn, who he brought in to advise him, and Kahn said we need to deregulate, especially in transportation, and he really kicked that process off, and that I think made a huge difference. I mean, Kahn really becomes prominent, very late in the Carter administration, in time to help things improve under Reagan, by which time Kahn and Carter are long gone. There is no such person in the Biden administration, and I doubt that there will be. So I don't think the election hits the economy much at all. As for investments, well, Tom, if you want to try my strategy of buying puts as the S&P goes to 4,000 and buying calls as it gets 3,500, you're welcome to try it. Just keep in mind I haven't put a nickel into that myself. So I think it's tough. I mean, the arguments that people are having about whether interest rates are too high or too low are just unending. They're too low. Interest rates are too low if you want to do the naive projection that inflation is just going to keep going at 8%, then you can't have interest rates at 5 and inflation at 8 and expect to get anywhere. Getting anything other than wild inflation. But if you think of interest rates relative to kind of where they, are they high enough now that the stock market is reeling, the housing market is reeling, maybe they're high enough. Okay, so I've seen some glimmers of hands. Robert Boyd, you had a hand up. If you want to talk, go ahead and unmute. Yeah.
No, it wasn't me. It was Mike.
Okay. I also saw Mike's hand. Okay.
Yeah, I just was reflecting on one of these calls earlier in the year. We were talking about betting against government bonds, right?
Yeah, right.
But the rates have doubled since then. So
Right.
that plays off the table. And you got folks like Lee who you're in the spot right now, are like, hey, maybe they went too far too fast. And like this does feel like I don't know how much farther they can go. Even though they're not going to cure inflation at 4%. The economy and the government financing its own debt, they can't move much farther than this. So it's confusing as hell.
Yeah. Yeah. Well, well, I don't know how it does seem like the bond market in the UK all of a sudden said, no more deficits. And, I don't know whether that's going to hold here or not. Yeah. Dwayne, go ahead.
Arnold, what are the conditions that you need in order to forecast the Fed start starts to lower the rates. So pendulum swings both ways. The Fed raises rates, the Fed lowers rates. We're clearly in a tightening phase. What conditions do you need to see before you get on this call and tell us all right, over the next 6 months, we can expect the Fed to ratchet down the rates?
Okay, well, I want to put in a commercial for my PSST view that the Fed is just a bank, and that the bond market is out there setting rates, and the Fed doesn't set them any more than Citicorp sets them. It's a big market. And I know that it's not as much fun as being a Fed watcher, but that's me. So the question is, what will the market do ultimately? Is 4% in the long-term bond rate or 7% in mortgage rates high enough that you get disinflation, inflation coming down? Where would I put my money on that? I'd say at this point 60-40 that it will be enough. It certainly doesn't make sense relative to recent inflation. So I guess I'm believing that the markets will be pretty much right about that inflation's going to come down. I don't know. As I say that, I'm not sure how strongly I'm willing to believe it. But I don't know. We have squeezed some wealth out of the economy. We have raised people's cost of living. But are people saying ouch yet? I mean, if if they're doubling up in apartments, that's saying ouch, but maybe that's called adapting, and they're going to keep spending on everything else. But I would say I'm sort of with the market on disinflation, but probably because I think that the employment falling off a cliff is still a scenario. The other thing, and this goes back to your retailers, I still suspect that a lot of these businesses that have, now hiring signs in front are actually zombie businesses that if they had to pay a market wage, they wouldn't have those now hiring signs on. The hiring means they'd be happy to hire at what they think is an appropriate wage, but which they can't get people to work at. So I'm still waiting for some of these zombie businesses to kind of fold and see what the consequences of that are. So that's another kind of falling off a cliff story. Yeah, Mike, did you have another comment?
I was just agreeing with you.
Okay, and Tom?
Yeah, on the businesses folding, what's the place to look for data of how many businesses went into bankruptcy? I mean, we didn't talk about that, but that does seem
Yeah.
to be a key data point.
Yeah.
And I think that we should watch it.
Yeah, no, I think that's right. I still think a trend is for sort of the American dream to suffer, in that, the American dream is, you come here as an immigrant and you open up your little shop or your little restaurant. And I just think, I just think there's this long-term trend for those things to be eaten by the major corporations, and for the top corporations to take over. And that's a story for how the stock market can kind of do better than the economy, which it kind of has been for quite a while. That it's the corporate sector taking over from the mom and pop sector. you know, you just look at what Walmart did to the corner drugstore. You look at what the restaurant chains can do to restaurants, and yeah, I just think that the major corporations can, during the pandemic, the way Amazon or Costco could survive, and the little guy, where do I can't get my customers into my store, I can't get my supplies. So I have this pessimistic view about the American dream sector, as it were. So shall we end on this pessimistic note? That's always good to do. All right. So thanks, everybody. And I will upload a recording.
That'd be great. Thank you.
Okay.
Thanks all.
Bye.